This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In our first lecture on inheritance tax, we got used to and got introduced to the concepts so far as IHT are concerned. We learned that usually the one and only encounter with IHT for a taxpayer is when they die. And when they die, for most taxpayers, the only chargeability that may ever arise is in the context of their death estate or chargeable estate at death. And then only if the value of that chargeable estate at death exceeds the available nil rate band. And that's based on a current nil rate band, and one that we've had for many tax years now, ever since I think it was 2009-10. We've had £325,000 as our available nil rate band. Now then, the nil rate band, £325,000, means that if you die having made no gifts in lifetime with an estate worth £300,000, there will be no IHT to pay. You will die happy in the knowledge that everything that you owned will pass on then, presumably to the next generation, without fear of IHT. However, if, as will be the case in any exam question you get to deal with, the value of that chargeable estate is significantly greater, then, of course, above the nil rate band, there will be a 40% tax charge. That is a very significant tax charge indeed. So, let's pick it up, therefore, in relation to that death estate and see how it is that we use the so-called available nil rate band. Because remember that when you die, though for most taxpayers the only chargeability will be in relation to their estate, in any exam question you are likely to find, shall we call them, a more interesting taxpayer than that. One that did indeed make lifetime transfers, made gifts in lifetime. And because of that, then we've only got one available nil rate band to use. We will discover that that nil rate band will be used firstly by the lifetime transfers becoming chargeable on death. Now, what lifetime transfers become chargeable on death? Only those made within, do you remember, I hope we do, 7 years from the date of death. So, what have we got therefore in relation to the chargeable estate? I'll come back to this, I'll put it in inverted commas here, available nil rate band is deducted from the value of the chargeable estate. We know that the nil rate band, it's given in our fact sheet, our rates and allowances pages, is £325,000 for our 2015-16 tax year, and has been so since about 2009-10. The available nil rate band is the £325,000 reduced by the value of any lifetime chargeable transfers made by the deceased in the 7 years before death. As we just said, if you had no lifetime transfers, the full nil rate band would be available against your chargeable estate, and only the excess above 325 would be taxed at 40%. But if you had made lifetime transfers within the 7 years before death that exceeded £325,000, then all of your chargeable estate at death would be chargeable at 40%. There'd be none of the nil rate band available then to go against the death estate. Now, this is why we said, you may recall the expression I used, and we'll be using it a lot over this and forthcoming lectures, is that IHT is a cumulative donor-based tax. That we cannot look at either an individual transfer in lifetime or indeed then the chargeable estate at death. We cannot look at them individually and hope to compute the tax, though we know a nil rate band and we know above that a 40% rate of tax on death. Because this is cumulative. That if I've given nothing away in lifetime, then my £300,000 estate at death is fully covered by the nil rate band. No tax is payable. But if I had made £400,000 of gifts in lifetime within the 7 years before death, then there is no nil rate band to go against my chargeable estate, And if I have 300,000 in that chargeable estate, all of it would be chargeable at 40%. So it's a cumulative donor-based tax. More of that with detailed illustrations as we go through. Right. If there is any tax payable in relation to our estate, the IHT liability has to be paid by the personal representatives, though again the term executors may be used here, before they get letters of probate. Yeah, again, probate will be said to be granted. What that means is it allows the personal representatives to then distribute the estate to the beneficiaries. So until the IHT on the estate has been paid, those as assets are held within the estate. They may not be distributed, they may not be transferred to the ownership of the beneficiaries. Now clearly this is something that those that remain behind after the date of death would seek to do on a speedy basis. So it is likely that the personal representatives will try to get this done as soon as possible and pay off any tax as soon as possible. But it is due anyway 6 months after the end of the month in which the taxpayer died. Now normally we would wait as long as we could before we would pay any tax. Here, however, is a tax that we would look to probably pay sooner rather than later. We wouldn't wait around because the beneficiaries would presumably wish to gain access to the assets, and they cannot do so until probate has been granted, and probate will not be granted until the tax has been paid to HMRC. In terms of you answering the question, and when will the tax be payable when will the tax be payable in relation to the deceased's estate, that will be due 6 months after the end of the month in which the taxpayer died. The IHT is suffered by the beneficiaries because the tax will be paid out of the deceased's estate. Then what is left over will be paid to the beneficiaries. Now there may be more than one beneficiary, and what we'll discover is that the person who bears the cost of the tax on the estate is usually a person known as the Residuary Legatee. There's a fabulous couple of words put together, the Residuary Legatee. Now that, again, although being a strange term and one that I'm sure that most of you, if not all of you, have never heard before, actually is a simple concept. The residuary, the one who receives the residue, legatee, a beneficiary who receives a legacy there. The person receiving the balance of the estate after any specific legatees have been paid out of that estate. So if when I die, I specify that I want A to receive £30,000, V to receive £20,000, F to receive £10,000, and C to receive my prized possession, my collection of Aston Villa Football Club programmes there, worth pounds indeed there, then the rest of my estate, after A, V, F and C have received their specific legacies in full, 30,000, 20,000, 10,000 and the Aston Villa football programmes, after those gifts have been made, the rest of the estate goes to X. X is the residuary legatee. Now whereas A, V, F and C will get what I have left them in full without any chargeability to tax, the residuary legatee X will receive what is left within the estate after the tax has been paid out of that estate. That is the residuary legatee. They bear the cost of the tax. Sometimes, of course, you do not leave your estate in that way. What I might simply do when I die is, other than leaving it to my spouse, of course, where there be no tax at all, it would be exempt, but I leave my estate to my two sons equally. There will therefore be no residuary legatee, and the tax will be borne equally by those specific legacies, my sons there. But otherwise, if there are specific legacies and a residuary legatee, it is the residuary legatee that bears the cost of the tax. Why am I telling you that? Because it is possible that in an exam question they ask you not just to calculate the IHT payable as a result of the taxpayer. They don't then just ask you to say when the tax would be due, 6 months after the end of the month in which the taxpayer died. They may also ask you to say who will bear the cost of that tax, which in relation to the death estate is, as we have just stated, usually the residuary legatee, X in my example. Right, but let's see about the calculations of the tax itself. Illustration 2. The humorously named departed now, a spinster. Now that just means a lady that never married. Why I'm telling you that, not just a little bit of background information about her there, but has relevance in terms of other issues. If she's never married, there is no spouse, therefore there's no spouse to give to, there will be no exempt legacies, no exempt beneficiaries there. Also, the fact that she's never married will have an effect in terms of she will only have available her own individual nil rate band. As we will discover, had she had a husband that had predeceased her and who had not used all of his then available nil rate band, then whatever proportion had been unused would transfer through to D. But that is not an issue here, and I will discuss those issues later on in this lecture. But departed, a spinster, never married, died. Unlucky D, died on the 1st of February 16, leaving an estate valued at 0.75 million. Now, you in an exam question may have had to have constructed that value for your estate, yourself there, listing out the contents of the chargeable estate at death. Maybe again listing out the property and deducting from it, or not deducting from it, a mortgage that was held on that property. But otherwise listing out, taking away the liabilities due at the date of death, and if there were any, clearly there aren't any here, any exempt legacies, i.e. what have you left to your spouse. Here though, the chargeable estate valued at 0.75 million. She'd made no chargeable transfers of value in her lifetime, and now bequeathed her estate to be split equally between her nieces and nephews. Right. Departed. Chargeable estate at death. Now look at the makeup, the presentation of this. Who are you dealing with? It's D. What are you now preparing? The computation is of the chargeable estate at death and state the date of death. You would now list out the assets if you'd had to construct this figure for yourself, but here her net assets, the assets less any liabilities due, £750,000, chargeable estate £750,000. Available nil rate band, no lifetime transfers have been made, certainly not within the 7 years before death, so all of the 325 nil rate band is available. So ever such an easy calculation, 325,000 at nil, leaving the remaining 425,000 pushed into the 40% band, and 425 at 40% is £170,000 of IHT that becomes payable as a result of the death of the taxpayer. The personal representatives will be required to pay the IHT liability of £170,000. When do we have to pay? Within 6 months after the end of the month in which the taxpayer died. When did the taxpayer die? February. 6 months on from the end of February is the end of August. Therefore, due to be paid by the 31st of August 16. Now, it's the personal representatives who will pay it. It's not their money. They will take the £170,000 out of the estate. Therefore, there is less to go to the nieces and nephews. it is they that have borne the cost of that tax. The tax will come out of the estate and hence is borne by the nieces and nephews. So if you were working here on behalf of the nieces and nephews, then you'd be able to say that out of the estate, net value £750,000, tax of £170,000 will have to be paid, and subject to any other expenses like the personal representative's expenses to be paid out of that. Otherwise, 750 minus 170, £580,000 of assets will pass then to the nieces and nephews, i.e. after tax has been deducted. Right. In any exam question we get, however, it is most likely that lifetime transfers will have occurred. So let's have a look at illustration 3, which is very simple, same as is illustration 2, i.e. D died and had a chargeable estate at death of £750,000. But this time she'd made a lifetime chargeable transfer of value of £200,000 in June 2013. June 13. She died on the 1st of February 60. Therefore, was that transfer within the 7 years of the date of death? Yes, of course it was. It was in June 2013. That means that on the death of D, what would become chargeable? Firstly, lifetime transfers made within the 7 years of the date of death. That is the lifetime chargeable transfer of £200,000 in June 2013. But it will be the first to enjoy the nil rate band of 325, and as 200,000 is less than 325, there'll be no tax payable in relation to that gift. So, as the chargeable transfer made in lifetime falls within the 7 years before the date of death, it will indeed become chargeable as a result of D's death. It will, however, fall within the nil rate band of £320,000. That is the figure in force at the date of death. It's again, the nil rate band we use is the one in force at the date of death. That is and will be for you £325,000. So 200,000, the value of the lifetime transfer, less than 325, so there will be no IHT payable on the lifetime transfer. But it does of course now mean that we started with a nil rate band of 325. We've used up 200,000 on the June 2013 lifetime transfer, so it means that the remaining available nil rate band will only be 125,000. The available nil rate band now against the chargeable estate, we're left with 125,000. So calculation then, simply enough, the 125,000 at nil, 625,000 then, that is of the £750,000 of chargeable estate, still remains, sadly, to be taxed at 40%. And look at the tax now on the estate at death, the chargeable estate. Look now, therefore, at what would be available to the nieces and nephews. Remember we said IHT is a cumulative donor-based tax. When there were no lifetime transfers, the nieces and nephews, the beneficiaries of D's estate, received all of the estate less tax, basically ignoring any other expenses that would be paid out of it. It would basically be the 750 minus the tax of 170, and that was what? A net £580,000. Now what will happen when D dies? The lifetime transfer in June 2013 is first to use the nil rate band, and there is no tax to pay on it. But that pushes now an extra 200,000 of the chargeable estate out of the nil rate band and up into the 40% band. That therefore increases the tax charge as we've just seen here, to 250,000. So now what will the nieces and nephews receive? Not 580, but 750 minus 250. That'll be only 500,000. IHT is a cumulative donor-based tax. Where there were no lifetime gifts, then the nil rate band was enjoyed entirely by the chargeable estate at death. Where there was a lifetime transfer, first come, first serve, it has used the available nil rate band to begin with. It's a cumulative donor-based tax. It leaves less of the nil rate band to go against the estate. So although it is still the nieces and nephews who are the beneficiaries benefiting from that estate, the amount of tax payable on the estate, on the assets that they then subsequently receive, is nothing to do with them. It is everything to do with the personal circumstances of the donor. Right, have a little look at those calculations, please. Make sure that you are happy with them for a moment, and then we'll proceed to our next example and our next points. Okay, now in illustration 4, just a slight change to the information given about D. Now, we were told back in illustration 2 that D was a spinster, and that, we said, meant that she'd never been married, so there was no spouse that she had or would have ever had. What we now do is to change the information to that D was a widow. Now, what that means, of course, is that sadly her husband has already died. A widow there, her husband has predeceased her. And when husband died, D had received all of her husband's estate on his earlier death. What does that mean? When the husband died, he left everything to her. That would therefore mean that that transfer, being between spouses, was exempt. So it means the husband would have made no chargeable transfers, as the transfers between spouses are exempt. So if there are no chargeable transfers, all of the estate was exempt. That means that the husband made no use of his available nil rate band. This would mean that 100% of his nil rate band would have been unused. Now, once upon a time, that would have been an irrelevant fact. A sad one, but an irrelevant one. But since the late 2000s, a huge and most important change arose in terms of our IHT legislation. A simple little change that was probably the most important legislative change in IHT since its creation. And what it now means is that as D has then died, a claim may be made for the unused proportion of the husband's nil rate band, it happened here to be 100%, to transfer to D. Now this, of course, this election would be made. The personal representatives would do this. Thus D's nil rate band would now be 325,000, which we all start with when we die, plus 100%, that being the unused proportion of the husband's nil rate band, times what is the current nil rate band, 325,000. So she's going to get 200% of the available nil rate band when she dies, currently 325, pushing it therefore up to £650,000. Now, of course, huge benefit to another £325,000 of the estate that would otherwise have borne tax at 40%, 40% of 325. That will create a very significant tax saving of some £130,000. Note that irrespective of the level of the nil rate band that existed at the date of the husband's death, D will now benefit from an extra 100% of the now available nil rate band when she dies. Currently, as we've said, 325,000. So if when husband sadly died, the nil rate band had been only £200,000, for example, and everything again was gifted to the wife, 100% was unused. So now therefore, when D dies, she doesn't get her 325 plus the unused 200,000 when he died. Oh no, she gets 325 plus 100% unused nil rate band. It works on a proportionate basis. It's not a financial figure, it's proportionate, 100%. So i.e. she gets an extra 100% of now her nil rate band. That's 200% in total. That's £650,000. If, for example, when the husband died, he had used half, 100,000 of the then 200,000 nil rate band, then 50% of the then nil rate band was unused. So now she would get 325 plus 50% of 325, i.e. 150% of 325,000 would now be her available nil rate band. So before you do any IHT calculations on either lifetime transfers or the death estate, calculate firstly her available nil rate band. Now, as I've suggested and as we saw in illustration 3, it is very likely that there will be at least one, probably maybe 2 or 3 lifetime transfers that occurred during the lifetime of the now deceased taxpayer. Now, when we see lifetime transfers, we've got to identify what they are. Now, all of these terms we have already used, but 2 of them we need to define and deal with more specifically. Firstly, what type of lifetime transfers might we be dealing with? Firstly, exempt transfers. Well, we know what they are, at least so far as our syllabus is concerned: transfers to spouses or civil partners, as we noted above. We also know that there will be chargeable lifetime transfers, CLTs as we know them. Remember that from the previous lecture? They were a very specific type of transfer made in lifetime. They, as I hope you recall, are transfers into trusts. So a transfer to a spouse, exempt transfer. Transfer into trust in lifetime, CLT. And any other transfers are potentially exempt transfers, or PETs as we know them, potentially exempt transfers. Remember what that meant. A potentially exempt transfer, no IHT when the gift was made, but if you die within 7 years, then it becomes chargeable on death. Whether there is any tax, of course, to pay at that point will depend on the availability of any nil rate band to go against it. But if you'd made a transfer into a trust, a CLT, as we keep underlining here, then that has 2 occasions of charge. One, in lifetime. So when you made that transfer, and as a matter of interest, and a point we'll see later, it's chargeable when made using the then available nil rate band. Again, if you made a CLT, a transfer into trust, back in 2004, then you didn't know you were going to die in 2016, nor what the then nil rate band would be. So at the time, you'd have used the available nil rate band and the tax rates applicable at that point in time. We will see how to deal with that a little bit later in this chapter. Plus then, if you died, and only if you died within 7 years of having made that transfer, then there may be additional tax to pay. It would certainly be relevant in terms of your computations, but it may end up that there may be little or no additional tax to pay. But you've got to do the calculations. So we've been introduced now to these 2 terms, PETs and CLTs. So we need to look at those, therefore, now in rather more detail. Okay, so first of all, PETs, therefore. Well, we know what one is. It's a lifetime gift made by an individual to another individual. Well, to another individual other than, of course, your spouse or civil partner. Transfers between spouses and civil partners we know to be exempt. But otherwise, any other individual, usually in exam questions would be something like your kids, grandchildren, nieces and nephews there, then these are potentially exempt transfers. What does it mean? Well, basically, when it is made, it is potentially exempt. There will be no IHT liability at the date of the gift. And as we also know, there will never be any IHT liability so long as the donor survives for more than 7 years from the date when the gift was made. That would mean that what was potentially exempt when made will have become fully exempt, and therefore will be ignored for IHT purposes. It says here, if the donor survives more than 7 years from making the gift, it's fully exempt and is ignored for IHT purposes, though something you haven't yet seen, it would still be deemed to have used up the annual exemption or exemptions that might have been available in relation to the tax year in which the gift was made. Now again, it says see later note, there are a number of exemptions that may apply. The most likely and the most obvious for us will be an annual exemption. It's like what we've seen already with the personal taxes. In income tax, you've got a personal allowance, a level of tax-free income. In CGT, you have also called an annual exemption, an annual exempt amount as it's known there. That's a level of tax-free gains. And so it is with IHT. There's a level of transfers that you can make each year. It's not very big, it's only £3,000 per such tax year. Don't worry about noting it, we'll see it later. That represent an exempt level of gifts that you may make in lifetime, therefore. And that figure hasn't changed, unlike with personal allowances, with AEA's annual exempt amounts. These go up each year. We've had a steady level of 3,000 for all of the time that you will have to deal with so far as any exam question you see. Sadly, that one hasn't uplifted over the years. It's just a standard, a set £3,000. What you're going to see, of course, is in an exam question that although maybe there is a pet that is more than 7 years from the date of death, so is not chargeable when made, is not chargeable when you die, certainly it's likely that there'll be at least one that was made within the 7 years of death. So if the donor dies within 7 years of making the gift, it becomes chargeable on the death of the donor. IHT is then payable, as we know, at 40% on the value of the gift, less, of course, any available nil rate band. Now, back again in illustration 3, we saw where a lifetime gift had been made by D in June 2013, I think it was, there. And in relation to that gift of £200,000, it was the first gift that had occurred within the 7 years before death. Indeed, it was the only gift. Therefore, it took the benefit of the nil rate band. That meant that there was no tax to pay. Had we gone above £325,000, then 40% tax would have been payable. That is the case if the taxpayer did not survive for at least 3 years. If the taxpayer, let's say that again, if the taxpayer did survive for at least 3 years from the date of the gift, so in the example I gave you, there was no tax to pay on the £200,000 because it was less than £325,000. But as we have just said, if the amount of that transfer had gone above £325,000, then tax would have been payable at 40%. But if the taxpayer had managed to survive, not for the 7 years that would have made the transfer exempt, but had survived for at least 3 years from the date of the gift, then any IHT charge that arises would be reduced by the available taper relief. Now that is going to come up soon in note 5 below. So any tax made or payable in relation to lifetime transfers, if the lifetime transfer, remember, it's taxable because it's less than 7 years from the date of death, but it is more than 3 years from the date of death, so between 3 and 7 years from the date of death. It's taxable, but then there is taper relief that works on a sliding scale that the closer and closer you get to 7 years, where the transfer would then have been exempt had you lived for that long, that the level of the taper relief will increase. Well, we'll see it. Information will be provided to you. It moves in some 20 percentage points, that the tax charge is reduced by 20% if you manage to survive between 3 to 4 years to the date of death from the date of the transfer, rising to a level of 80% taper relief, i.e. a reduction in the tax charge, if you manage to survive for between 6 and 7 years from the date of transfer through to then sadly the date of death. But more of that later. If there is IHT payable, then any IHT payable on the pet is paid by the donee. Now remember, the amount of tax payable on the pet is nothing to do with the donee. This is a cumulative donor-based tax. It's got everything to do with the donor and where your gift falls in relation to any other lifetime gifts made within the 7 years before the date of death. So the amount of IHT payable is all to do with the donor, but what has to be paid will be paid by the donee. Where more than one pet has occurred within the 7 years before death, then the nil rate band is applied strictly on a chronological basis, i.e. first come, first serve. The earlier transfers will benefit from the nil rate band. Now, let's finish off probably this section by dealing with illustration 5. Going back as it was to illustration 3, remember D had died with an estate of some £750,000. In illustration 3, we had seen a lifetime transfer in June 2013 of £200,000. So as in illustration 3, but D, we're now told, has made 2, now I'm using the term chargeable transfers in lifetime of £200,000 each. The first was in June 2013, we've already seen that in illustration 3, and we've then got a second such transfer in August of 2013. Again, same year, but it's in August 2013. Compute the IHT liabilities arising as a result of D's death. So, we deal firstly with lifetime transfers that become chargeable on death. Do we have any? Yes, D has made 2 pets, both within the 7 years of the date of death. These will now become chargeable along with the chargeable estate, and the IHT computed as follows. When dealing with lifetime transfers chargeable on death, we go back 7 years from the date of death and then start to come forward. So, when did D die? That was, I think, the 1st of February 2016. So we go all the way back 7 years. So what would that be? To the 1st of February 2009. And any such lifetime transfers from the 1st of Feb 09 through to the date of death, the 1st of Feb 16, would now become chargeable as a result of D's death. Now the earliest of those for us, and where we start this computation, is June 13. So head up the computation, lifetime transfers chargeable on death, then put in the first of those transfers, June 13. What was it? It was a pet. We'll then run 2 columns on the right hand side of your page, one entitled gross transfers and the other tax, or, well, the tax is IHT there. Right, we now start to use up the available nil rate band. It's 325 at the date of death. We're going back to illustration 3, so remember back then D was a spinster. We did not have, as we saw in illustration 4, the basically double amount of nil rate band that would be available. June 13 pet, £200,000 is your gross transfer, no tax, it's all within 325. On to the next one, August 13, again a pet. You've used 200 of the 325 nil rate band, so 125,000 is now available, out of the 200, leaving 75,000 in the 40% band. That is £30,000 tax, so 200,000 transfer, £30,000 tax. Now, I did mention just above something about taper relief there, but that taper relief was only available, that reduction in the tax charge. There is your tax charge. It is to that taper relief would be applied, but that was only available if the taxpayer managed to survive for at least 3 years from the date of the transfer. This transfer was August 13. 3 years on from then would have been August 16, but the lifetime transfers chargeable on death. When did our taxpayer die? The 1st of February 16. That therefore means unlucky, didn't survive for the required 3 years for any taper relief to apply against the tax charge. So the 30,000 liability, that will be paid by the donee of the gift. It also means that we've now used the nil rate band in full on the lifetime transfers, so all of the chargeable estate of £750 will now be taxed at 40%, giving a further liability of £300,000 to be paid out by the personal representatives. Remember, who bears the cost of the tax in relation to the deceased estate. Here, as it was nieces and nephews that were jointly gifted the contents of the death estate, they are the people, the beneficiaries, who will suffer that tax charge. What we now see is how very differently the tax charge may be computed depending on what has gone on within the 7 years before the date of death of the taxpayer. In our first example, where there were no lifetime transfers, I think we computed something like £170,000 worth of tax. That tax then went up in illustration 3 to where there was a lifetime transfer to, I think it was 250,000, and we've now got a tax charge of £300,000 arising. It's the same chargeable estate, but based on the cumulative nature of this tax, a cumulative donor-based tax, because D had made now those 2 transfers within the 7 years of the date of death. It is they that have benefited from the nil rate band in order, firstly the June 13 PET and then August 13, meaning that no nil rate band is left to go against the chargeable estate at death, increasing the amount of tax charge that the nieces and nephews will effectively suffer. I'd like you to go back again through that illustration and make sure that you're happy with it. So pause at this particular point. Okay, well, final points now to make in this lecture. We've seen that in that illustration that both those PETs, those lifetime transfers, fell within the 7 years before the date of death. Therefore, they both became chargeable as a result of the death of the taxpayer. We charge them in order, chronologically, from the oldest one, the earliest within the 7 years before death, June 13, before August 13. We applied the nil rate band on a first come first serve basis, which meant that the June 13 PET suffered no tax charge. The August 13 had a reduced tax charge, but there was still a tax charge of 30,000, and it meant that there was no nil rate band then to go against the estate at death, pushing up the tax charge on the chargeable estate. As we note, therefore, finally here, it can be seen that if the taxpayer survives for more than 7 years from the date of the PET, remember what PET stands for, potentially exempt transfer, then it will be both exempt in its own right and in addition will have no effect on the chargeability of either those lifetime transfers falling within the 7 years before death or on the chargeable estate itself. So, if a PET, a lifetime gift, was made 8, 9, 10, however many, more than 7 years before the date of death, think what would have happened. In lifetime, it was a potentially exempt transfer. No chargeability to IHT when made. You then live for 7 years. That therefore means there will be no chargeability upon it when you die. Also, it will not go into this calculation of lifetime transfers chargeable on death. It's more than 7 years before the date of death. So it will not come in to this working here, where we see the cumulative effect of this tax, where the nil rate band was firstly enjoyed by the June 13 transfer and only the remainder by the August 13 transfer. A transfer, a PET more than 7 years before death, does not go into this calculation. This will only record lifetime transfers chargeable on death. PETs made more than 7 years before death are not included, and therefore will have no effect on these transfers that are chargeable. They will not be included within that cumulative total. Illustration 6, therefore, if in illustration 3 and 5 there had been an earlier PET of 200,000 8 years before the date of death, it would be exempt and would have no effect on the amount of IHT payable. It would not be chargeable in its own right, nor would it affect any of these transfers that have become chargeable, nor equally the estate at death. The computations would be as you see them there. Right. Take time before the next lecture, therefore, to get to grips with where we are so far in our studies, and then we'll continue on and add in yet more detail to the basic principles that now we have witnessed of what is chargeable and when in relation to gifts made in lifetime by the taxpayer, and then, well, gifts made, got no choice in it being made, of course, when you die, when everything then goes to whomever you have chosen as your beneficiaries. More of that in our next lecture together.